Welcome back. You're watching Markets at Noon, and it's time to deep dive into the market territory now and talk about your investment portfolio and what are asset managers, after all, looking at this kind of a market and what are the strategies that they are opting for your long-term portfolio. We are joined by Sanjay H. Parekh, founder CIO, Sohum Asset Managers. Sanjay, hi, afternoon, and welcome to the show. All right, so at this current juncture, how are you reading the market today?
Yeah, so overall, I think markets are not cheap. Valuations are fair, and I think we are going a little faster. So we think that that there could be a time correction and price correction both. Uh, Q4 was weak. Q1 is also going to be weak, and as of now, doesn't look like Q2, which is more like a lull season. The earnings recovery is not yet. I mean, all the earnings are yet to come out, but I don't think we'll have a clear recovery in Q2 as well. Uh, H2, I'm hopeful that all the benefits of lower interest rates, better monsoons, all the balance sheets or top down are very good. So that should hopefully reflect in earnings in Q3 onwards. And that's where I think, we should start looking better. So we think that, there could be a time correction and price correction both. And hence, from our point of view, we seek a higher margin of safety in our new entries that we do in our stock selection and in stock buying.
Agreed, Sanjay. Caution is vital, and that's what one should practice at this point in time. Time correction, price correction is both of it that you see. But along with that, also help us understand the sectoral approach and your outlook on the sector specific front. Which are the sectors which are looking good as far as the earnings season is concerned? And yes, I understand that the last quarter was mild, and this quarter the start is also not really great. But what are the sectors you're looking out for?
Yeah, so I'll tell you where we are positioned, and some of our portfolio companies also would have weak earnings, but obviously you don't invest for a quarter or so. So the way we have positioned today is we are domestic overweight, global underweight. And this theme is now consistently we followed for 3 years. So discretionary, we are mild overweight. Financials, overall, we are neutral. Banking, we are mild underweight because we think while it's known, but you'll see some pressure on growth due to NIMs in the first quarter and second quarter as well. And credit growth also is weak. Having said that, the valuations are reasonable. So we have a mild underweight on banks, nothing major. Overall, NBFC, housing finance, capital market, we are overweight. So overall financials, we are neutral. In capital goods, we are overweight because we think that selectively bottom up and the largest conglomerate is what we like. And then we have each of the sector represented by a stock where we like bottom up, like Polycap we own in consumer durable space, or DLF we own in real estate, or Sirma we own in EMS, or cement we own Ambuja and Grasim. So that's the way we are positioned. IT, we are underweight. Oil and gas, we are zero. FMCG, we are zero. So we do take sector bets, but our representation to consumer plays through the sectors that we discussed. So that's the way we are positioned right now.
All right, Mr. Parekh, hi, Ankur this side. Market has been range bound for quite some time now. I want to understand from you which will be the inflection point for market now. Is the wait for what we call about Trump tariffs, which is a lot of uncertain, is market waiting for that? Do you think earning season is something which is being washed out? Which factors you think market will consider for moving in either direction now?
Yeah, it's quite relevant, Ankur. So I'll tell you how we think about it, and we think about it quite deeply on this issue. So one is the balance sheets. I think the balance sheets are very, very good. I've never seen them since my career that I started in '94. So start with government balance sheet. I think very clearly the fiscals will be in control. The balance of payment situation is very, very good. Our RBI balance sheet, as you know how, and when they really wanted to relax, they have provided proper liquidity, almost cumulatively 7 lakh crores. Uh, so that balance sheet had the scope to do it, right? The banking balance sheet has the lowest NPA. The corporate balance sheet is at the lowest leverage. And the household balance sheet, at least at the mid and the top end, is very strong because of the gold effect, wealth effect, the real estate and equities. All of them have great wealth effect. So the balance sheets are in a very good shape. And so that is a positive. But the trigger, I think, is, and the second is the valuation. We're not cheap. So emerging markets are at 10, 11 times. We are at 20 times on FY27. If you take earnings of 1300, 1320 on 27, then we are already at 20 times. At 20 times would be 26,000. So a little less than 20 times at around 8, a little less than 15 times. So the upside from here, and I don't deserve at least, I don't think we deserve more than 20 times. Uh, Whenever we've gone about 20 times, the next 12-month return is weak. That's historically been proven. And so with that framework that we have, I think earnings recovery, to your question, is the key thing, which I think we have the whole set of, the boost given from the RBI side. The center should hopefully start spending, and we could see that recovery in the Q3 onwards, and that could be the trigger for the next move for markets.
All right, I think that will be all. Thank you so much for joining us today and helping our viewers with your long-term strategies and your take on the markets and investment side today. Thank you so much. Time for a quick break, but then post that lots of stocks and news and a lot of stock-specific action that we'll be checking in with our reporters and researchers after this break.